Video, we are going to concentrate on how to prepare the financial statements of a sole trader. We'll start by looking at some questions from the Cambridge November 2015 paper 1-3. We are just looking at paper 1 style questions in this video, in other words, the multiple choice. Number 22. During the year ended 31st of March 2015, a business made sales of $560,000, of which 25% were for cash. In other words, you need to point out here, or remember for yourself, the other 75% must have been on credit. The trade receivables at the 31st of March 2014, in other words, at the beginning of the financial year, were $52,000, and at 31st March 2015, or the end of the year, they were $56,000. The fact that they've given you both balances will help you to work out the average figure that you'll need to use for this calculation. The question asks, what is the trade receivables turnover based on average trade receivables? Well, what you'll need to do over here is firstly identify the formula that you need to use to work out your trade receivables turnover. In other words, how long it takes your debtors or your customers to pay you. This can also be known as the debtors collection period. It means exactly the same thing. And you'll work it out by using your average receivables, or the amount owed to you at the beginning plus the end divided by 2 to get the average, divided by your credit sales. The fact that you need your credit sales is because you are only looking at your credit customers. So it wouldn't make sense to look at total sales. And this is why you need this percentage over here, because your credit sales were 75%. So you'll average your beginning and end receivables figures. You will take your total sales times 25%. And then you just say times 365 for the number of days. This is obviously assuming that your sales were for an entire year. If out of interest this was for a month, you would only need to say times 30. So this is the period that you are looking at. And then you would end up with an answer of 46,93. In other words, you're talking about 47 days. Always remember in your calculations what you are actually looking for. In this case, it's your number of days that your customers, your credit customers, take to pay you. And so you would choose C. Remember, you will always work out your answer first. We get 47 days, and then you will go and have a look over here and see which answer is the most suitable, in this case C. We're now going to look at Cambridge Specimen Paper 1, number 8. An item can be converted easily into cash. In which section of the statement of financial position would this item appear? Well, if we can convert it into cash, that means it must be some kind of asset, because a liability certainly wouldn't convert into cash. It would do exactly the opposite. So we're talking about some kind of asset, and the fact that we can easily convert it into cash indicates that it must be a current asset. And so therefore, we would look for the current assets, or number B. And over here you can see my thinking process. So B is going to be the answer that I will use. Cambridge March 2016 paper 1-2, question 8. The statement of financial position of a company shows the following, and we have a variety of items given over here, a number of different pieces. Let's quickly first go and find out what we want. What is the total working capital? First, identify what do we mean by working capital. Basically, that term working means that we are using it in the short term for the day-to-day operations. So in other words, we are looking for all our current items. And in fact, you are going to want to use your current assets and your current liabilities and work out the net effect of that. Working capital is sometimes referred to as net current assets, because it's your current assets less your current liabilities. So let's go and have a look now and see what items or what options would actually be suitable over here. From the top, the tangible non-current assets, The term non-current, certainly we don't want it, and the same for intangibles. Both of those are non-current, and so therefore they will not be options. Trade receivables is a current asset, so we'll use it. And then trade payables is a current liability. Now, we are going to use it, but because it's a current liability, I need to remember to subtract it. I want to say less that 3,200. The loan repayable in 3 years, that is certainly a non-current liability because it's talking about 3 years, so it's long-term, not short-term, so we will exclude that. The bank balance, because it is a credit balance, that is telling me that it is an overdraft and therefore it is a liability, so I will need to subtract it, which is why I've said less. And then lastly, inventory. Inventory is a current asset, so I will add it. I then do all my calculations and I will come to an answer of negative 7,100, which means I actually owe more than I've got, which is quite an interesting one. And over here, my total working capital that I need is therefore 7,100. And so B is the answer that I'm going to use. Number 9. An inexperienced bookkeeper calculated a draft profit for the year ended 31st of December 2015 of 578,500. He had not accounted for the following items. There's provision for doubtful debts balance that changed and the provision for depreciation balance changed. What was the revised profit for the year? Well, the first thing that you will always need to do is start with your incorrect profit that was given, 578,500. We'll put that in as our starting figure. Then we want to consider our provision for doubtful debts and our provision for depreciation. Remember that both of these accounts are accounts that would appear, they're not incomes or expenses. They actually work together with the assets, but they decrease the assets. Provision for doubtful debts will decrease my receivables figure in the statement of financial position, and the provision for depreciation will decrease my tangible assets figure in my statement of financial position. So any change in these figures needs to have an impact on my incomes or expenses. Let's firstly look at these doubtful debt provision amounts. We started the year in the 1st of January with 12,800, but what was not taken into account is that at the end of the year, for some reason, that actually needs to get smaller. So either there are less receivables at the end of the year, or perhaps only a smaller percentage of them is expected not to pay. Maybe they've got better at paying. So you want to decrease your provision for doubtful debts. If you are going to make this provision smaller, it means that in effect you are going to create an income account for the adjustment. So I have shown over here a provision for doubtful debts adjustment. I always take the most recent figure minus the previous figure, and because I end up with a negative answer, that's telling me that it's an income. If you want to think about the T account, remember these would both be credit balances, and so to get from a credit balance of 12,800 to a credit balance of only 11,300, we would need to debit this provision account, which means I would credit my statement of income. And again, a credit in the statement of income or in any equity account means that I need to show it as an income. So that's why I've got 1,500 being added. Then we look at our depreciation. The depreciation was 95,000, but now we need to show a total depreciation of 126,200. You need to see the difference between the two again. Take the most recent figure, subtract the previous figure, and that will give you your depreciation expense, in this case 31,200. And then you can calculate your correct profit by simply adding and subtracting down to get 548,800. So you look for your options over here, and the answer that you are going to choose will be D. And that's why I'm going to choose D as my answer. Question 10. A computer used for demonstration to customers was treated as capital expenditure. At the end of the year, a customer purchased the computer in the ordinary course of business. So it started out being used as equipment because we're using it for demonstrations. But then what happened is somebody bought it, so it actually needs to change into cost of sales because we no longer have it as an asset and we need to offset it against our sales figure. So what entries are needed to adjust the cost of sales. And we are looking for what account will we debit and what account will we credit. As I've mentioned, the first thing we want to do is we want to adjust our cost of sales or debit our purchases as if we'd bought the inventory, because what we're doing is we're suddenly taking this equipment and instead we're transferring it or turning it into stock or inventory that is being sold. So it would be the same as if we had bought that inventory and then sold it to the customer, but instead we're taking it out of our equipment. So we need to debit the purchases account to show this. And then obviously we need to credit our demonstration equipment account because we've disposed of that equipment and we no longer have it. So if you have a look at the options that are given to you, you will see that B gives you the answer that you want, and that will be your choice. Question 11. A business makes up its financial statements to 30th of April each year. So that's my financial year end that I need to keep in mind. Included in the ledger account balances on the 1st of May 2014 was insurance, a debit of $800. Remember that if we have prepaid something, then it's going to be a debit. So this is telling us that we paid it in advance for this particular financial year. Then on the 31st of October, halfway through the year, an insurance premium of $2,100 was paid for the year ended 31st of October 2015. In other words, it's going into the following financial year. So yet again, we have now prepaid in advance. And the question asks, which amount was charged for insurance in the income statement for the year ended 30th of April 2015? In other words, what was the actual insurance expense for this period? Well, the easiest way of doing this is to actually draw up an insurance expense account. I love my T accounts. I always find they make it much easier to see what is actually happening. So let's put in the information that was given. We were told that previously there was a debit balance of $800, so you can pop that in. Or you could also have showed this as a prepaid expense at the beginning of the year. That's what's sitting there now. Then you will need to work out that you have prepaid an amount of $2,100 times 6 months out of the 12 months, because that $2,100 relates to 12 months, but 6 of those from the 1st of May 2015 to the 31st of October 2015 are not in the current financial year. Right now, we are on the 30th of April 2015, so those further 6 months need to be prepaid to offset this bank figure that I have paid, because that $2,100 is not all relating to this financial year. Once I have got those 3 figures in, I can then work out what my overall expense was that goes off to the statement of income as a missing figure, shown here in green. So I now need to look for an answer of 1850, and there I can see it. My answer will be B. Number 12. The statements of financial position of Go's business showed the following. Net assets at the beginning of the year $152,000 and at the end of the year $184,000. But what do I mean by net assets? Remember, net means you are subtracting something from it, and if we're talking about assets, we want to subtract our liabilities, and assets less liabilities actually means we are talking about the equity. Net assets is the same as saying my owner's equity balances were these amounts on these dates. During the year ended 30th of June 2015, so now I've got my year end date and I know when we are talking about, Go brought his own motor car into the business at the value of $14,000. The net book value of this motor car at the 30th of June 2015 was $13,200. So he contributed additional capital. Even though it's not cash, it happens to be a motor vehicle, he had contributed additional capital, and at the time that he contributed the capital, it was worth 14,000 Rand, somewhere in the middle of the year. At the end of this period, it was only worth 13,200. Why? Well, obviously it would have been used for some of this financial year, and the difference between those two figures tells us that it has depreciated by $800. However, that depreciation would be shown in the normal course of business in the financial statements or the statement of income specifically, so we don't need to worry about that too much right now. He also withdrew $7,900 cash from the business bank account. That would be drawings. We then need to calculate what was the profit for the year. Again, what we're going to do is we are going to work out what actually happened. Well, at the beginning, we'll put our $152,000 balance in. We are going to show the $14,000 as the capital introduced, because that's what it was worth when it was introduced. The fact that it's worth less later is not the owner's problem, it is part of the business operations. We are going to ignore that depreciation because we would include it in the profit that we are actually calculating, so we don't need to worry about that. We need to show our drawings of $7,900 cash, and obviously that would be subtracted. And then profit needs to be worked out as a missing figure. My net assets at the end are going to be $184,000. So in other words, you're going to say $152,000 plus $14,000 minus $7,900 plus X equals $184,000, and then solve for X. You should get an answer of $25,900, which then means that you are going to choose A as your answer for this question. We're now going to move on to the Cambridge paper from June 2016, paper 1-1, question 8. A company calculates a draft profit for the year of $88,000. This includes the profit margin of $3,000 on goods sold on credit, but not yet paid for. Well, the fact that we have actually sold them but haven't received the cash doesn't mean that we're not going to get the money. It just means the cash hasn't changed hands, but the transaction has taken place. And so therefore, this should be part of that profit. There's no problem there. However, it also includes $500 profit taken on goods that were sold to a customer on a sale or return basis. Now remember, if it's a sale or return basis, basically it just means the customer is looking at these goods and deciding if they want them or not. The invoice has not actually necessarily been issued as yet, and the sale has not actually taken place. You can't be sure of the sale. So therefore, to calculate the correct gross profit, you would need to exclude that $500. So your draft profit of $88,000, you are going to leave the goods that were actually sold, they should be there, but you are going to subtract $500 for the goods on sale or return because you haven't actually sold them, so you need to reverse that transaction, and your correct profit should be $87,500, or answer C. Question 9. The draft profit for the year for a sole trader was $108,000 before the following were taken into account. Even though I don't even know what my question is, generally I can assume my question is going to be what is the profit. So I might as well start with that draft profit of $108,000. Number 1. The provision brought forward for doubtful debts was $1,850. The provision to carry forward should be $2,250. So that means they have forgotten to adjust the provision for doubtful debts, and it needs to be increased from $1,850 to $2,250. In other words, I need to credit my provision account and debit my statement of income, which means it would be an expense of the difference between those two figures. So the adjustment would work out as an expense of $400, which I need to subtract. Number 2. Depreciation of non-current assets has been undercharged by $2,000. In other words, they have forgotten to depreciate something by $2,000, and so therefore you need to make that expense higher and subtract a further $2,000. Number 3. An accrual of $600 for repairs had been treated as a prepayment. If it was an accrual, in other words owing, and it was treated as a prepayment, it means you would have done something on the opposite side of the account, and therefore we need to double this figure. So we will need to adjust by $1,200. But do we add or subtract? Well, What we should have done was debit the repairs account, because remember, the repairs expense, you are working on the debit side, and so therefore if there's still some owing, you would need to add it on the debit side, but it was credited by accident. So because you need to debit it, you need to subtract it because there's more of an expense than we thought, and we actually need to do it twice. Once to get rid of the income that wasn't an income, and once to create the expense that should have been there. We are then able to see that the correct profit should be 104,400 Rand, or A. So there are the options, and you can clearly see your answer. The next question is question 10 from the same paper. The following balance appeared on a trial balance at the 31st of December 2015, after the preparation of the company's financial statements. Stationery, 8,000 debit. Now, if you've already prepared the financial statements, it means that this amount must have been in the statement of financial position, because the expense accounts would all have been closed off at this point. That means, if we're looking for what does this represent, remember that A, an amount due to the company's stationery supplier for 2015, that would be a liability account, and we're not looking at a liability account, because remember, if it's on the debit side, it means it's an asset. It basically means that stationery was paid for in advance. So we don't like option A. B, a prepayment made to the stationery supplier at the end of the year. That would be an asset, and so yes, that is certainly a possibility. Either a prepayment made to the stationery supplier, or if we had stationery on hand that we haven't used, either of those would be an asset. So we do like B, but before you get too excited, mark it as an option, but keep checking the others in case you find something that seems to be more correct. Inventory of stationery at the 31st of December 2014. Well, if this said 2015, then I would have said yes, B and C would both have been options. However, because this is 2014, that's the beginning of the financial year, and it is not suitable for what I am looking for here. So C is therefore not an option because of the date. Always be careful to check your dates. And D, the annual stationery charge for 2015, D is referring to the expense for the year, which cannot be, because we're looking at the statement of financial position, not an expense. And so therefore, B will be the answer that we need to use. 13. A business provides the following information. We have figures given for accrued expenses, accrued income, prepaid expenses, and prepaid income. And we are asked, what is the total amount to be included in current liabilities? Well, before we start, we need to simply identify which of these are the current liabilities or payables and which are receivables or assets, as we want to exclude the receivables or assets and only use the payables. Accrued expenses mean that it is an expense that is owing, and it must be therefore an expense owing to somebody else. So accrued expenses would be a current liability, and I would certainly include accrued expenses. So 9350 will be the first part of my calculation. Accrued income means it is income that is owing, but income means it must be owing to me and therefore is an asset, and I will not use it. Prepaid expenses means that it is paid in advance, and if it's an expense, it was paid to somebody else in advance, which means actually they owe me. And again, this would be a receivable or an asset, so I ignore it. Prepaid income. Income is paid to me, and if it was prepaid, it means somebody has paid me before they needed to, and therefore I actually owe that back to them. So this figure of 32650, I would include in current liabilities, and my total current liabilities from these figures here would be 42,000. Obviously, I would also add my trade payables, etc. to that. But for this question, it's 42,000, and my answer is C. We'll now go and look at Cambridge, June 2016, paper 1-2, question 8. In an income statement, carriage outwards of $5,000 has been treated as carriage inwards. Carriage inwards of $3,000 has been treated as carriage outwards. So basically, somebody is just a little bit confused here. So what we need to do is try and recreate those T accounts as they should have appeared, and then go and answer the question of what effect these errors would have had on the profit. And specifically, we're looking at both the gross profit, and remember, gross profit is calculated as sales less cost of sales, as well as profit for the year, which is our total incomes less our total expenses. So, firstly, let's look at these two accounts. Let's have a look at the carriage inwards of $3,000. Carriage inwards should have a balance of $3,000 on the debit side, but firstly, carriage outwards. Carriage outwards of $5,000, so carriage outwards needs to have $5,000 on the debit side, has been treated as carriage inwards, and so the error is shown at the top over here as 5,000. However, carriage inwards is the opposite. It should be 3,000, but it has been treated as carriage outwards. So if we look at these two accounts, we should easily be able to see that my carriage outwards has been understated by 2,000, and my carriage inwards has been overstated by 2,000. Remember that carriage outwards is simply an operating expense. It's the carriage or the delivery fee that I'm paying on goods that are being sent to the customers after the sale. So it's a selling and distribution cost or a marketing cost. And it is only part of my operating expenses, and so therefore it would only have an impact on my profits. So based on this, my profits are going to be overstated by 2,000. I'm just going to make that window a little bit bigger so that you can see it more easily. Carriage inwards, however, is the delivery fee paid on goods coming into my business. In other words, it adds to the cost of sales. So in this case, my cost of sales is overstated by 2,000. Remember, the cost of sales will impact on the gross profit. So the gross profit will be overstated because the expense has been overstated, cost of sales is the expense that's overstated, so gross profit would actually be less than it should be, and gross profit impacts the actual profit, so both gross profit and profit are understated by 2,000. So if we now compare both of these effects, both of them you can see do actually impact on the profit. In this case, profit is overstated, and in this case, the profit is understated, which means at the end of the day, your profit is actually going to be correct. Your profit for the year will be the same. However, your gross profit is understated at the beginning. So your net effect is that your gross profit is understated by 2,000, but the overall profit is correct. And if you go and look at the options given to you, you would want to choose C, showing that there's no effect on the profit, but gross profit is understated. Then, question 9. A company received interest of $8,800 during the financial year. Interest of $700 was due at the beginning of the year and $850 due at the end of the year. Which entry appeared in the interest received account to make the transfer to the income statement? In other words, what was the actual interest received income for this period? Again, let's draw up a T account to illustrate what is happening. We know that they received $8,800, so that will be the bank figure on the credit side. We'll credit the income account because it increases equity, and equity increases on the credit side. We are told that interest of $700 was due at the beginning. If it was owing at the beginning and it's an income, it means it was owing to us, and therefore it was an asset or a debit balance. So we would need to show that as a debit in this account. But at the end, 850 was owing. So it's owing at the end. It means that it needs to increase the income for the purposes of the statement of income. So I need to show 850 on the credit side. I can then work out my missing figure here as 8,950 being the total income for the period. And if you look at the options, you will see that that gives you D. Question 10. Katrina commenced business on the 1st of January 2015. For the year ended 31st of December 2015, in other words, the very first ever financial year end, the following information is available. Drawings, profit, revenue, and expenses are all given to you. You are then asked what was the cost of sales for the year. In order to calculate the cost of sales, you could recreate a mini statement of income, which would have revenue, cost of sales as your missing figure, expenses, and then the profit for the year. Remember that drawings is not a business expense. Drawings would be shown directly in the capital account or in the notes to the statement of financial position. So I'm going to ignore that figure completely. It will not be part of my calculation. However, I can recreate a little mini calculation of the statement of income, with revenue being shown as my 1.5 million, cost of sales is my missing figure, so you could just make that X. Expenses of 875,000 would need to be subtracted to give a profit of 62,700. If I solve for X, I should be able to find out that I would have needed to subtract a cost of sales of 562,300, and if I look at all the options available, I will choose A as my answer. Question 11. The following information is available for rent and rates. Very similar to previous accounts, I'm given my prepaids and accrueds, but in this case what I've got is a rent and rates account that is combined. So they are both prepaid and accrued accounts in the same account, and then a combined amount that was the actual expense for the year. So I do it using exactly the same concepts. For my rent and rates account, I will show what was the prepaid rent at the start. Prepaid rent would have been debited because it's an asset, it's a receivable account, whereas accrued expenses would have been a payable. So I show that on the credit side. The income statement figure I'm going to put in over here, and because rent and rates is going to normally be debited as it is an expense account, I would close it off on the credit side to statement of income, and statement of income would then be debited, which is correct. At the end of the year, if I am owing money, the accrued will obviously go on the debit side because I still owe it, and prepaid will be on the other side. And then I can work out my missing bank figure for rent as 8940. So my answer will be D, 8984, sorry. And that concludes this revision video. I do hope it has helped.